Good afternoon. Accounting 230. We're on to chapter 10, dealing with long-term liabilities with quite a bit on bonds. So let's get going here. I promise to share the screen and not babble to an empty presentation. I trust you can see the screen now. Accounting for long-term liabilities. Any debt that's not due in a year is a long-term liability. Some learning objectives. Companies can raise money in various ways. You put your own money into the company, huh? But if you're a big company, chances are you're going to either do it through debt or equity. If it's through debt, you're going to finance a bond, or if it's through equity, a stock financing. Bond financings, transactions during the bond life, okay? Bond financing, a bond is a debt. It's a borrowing instrument. A company says, they announce to the world that they want to borrow $10 million, and they describe why they want the $10 million, what they hope to do with it. And most importantly, I suppose, what the interest rate is they're willing to pay. And the public looks and they decide that that's a good investment. They will loan the money to this company. The company might have a 30-year bond. Let's make it a long one, huh? And the deal might be the company's not going to pay you back your $100,000 for 30 years. But throughout those 30 years, you're going to be accruing and receiving interest income. Okay? So we have a couple terms. The bond issue date. That's when the bond is, when the money changes hands at the time of borrowing, okay? Bond financing, advantages and disadvantages. Bonds. And advantages, if you borrow the money, you're not affecting the ownership of the company at all. As opposed to a stock issue, you issue stock to the public now owns some of your company, and you've lost a little bit of control in terms of voting strength. At least the interest on the bonds, the taxes are, the interest payments are at least tax deductible, huh? And bonds can increase your equity a little bit. What they're really getting at there is if you borrow money at 3% and you're able to invest it at 4%, that's a return on equity. But there's disadvantages with bonds too. A bond requires a payment every 6 months or every year, depending on what the deal is. And then at the end of the bond's life, which is called the date of maturity, at the maturity date, you have to pay back the whole 100,000 or 10 million. And the bonds can decrease your equity. If you go out and you borrow money at 5%, and then the interest rates go down to like 2%, you're crazy to keep borrowing at 5%. The interest rates are now 2%. So your bonds are worth less. And here's a typical, looks to me like somebody bought stock in the Minnesota Vikings, huh? It's just a stock certificate, in this case, a bond certificate. It has the information, which is kind of hard to read here, but it says we borrowed $10,000. Here's the interest rate. Here's when the bond begins. Here's when it ends, that type of thing. Bond trading. A bond is similar to a stock in one way. They trade on the market daily, okay, on the market. Not the stock market, but the bond market. Bonds are securities that can be bought or sold in the securities markets. They have a market value, which is expressed as a percent of the par value. The closing price indicates that IBM bond is being sold at 103.08% of face value. Let's understand what par value is and face value. They are the same thing. Par value, face value. That's the amount of money you borrowed. The par value, the face value, is going to be the number that ends with a bunch of zeros, like 1,000 or 10 million. No one has ever issued a bond to the world for $99,842.06. No, the par value is going to be the big number that you're borrowing. In this case here, IBM apparently is offering a pretty good interest rate, 3.81, and that's attracted some attention. So these people are willing to pay more than the $100,000 to collect this almost 4% of interest. And we're going to talk about how we handle that. Prepare entries to record bond issuance and interest expense. Okay, here is a simple one. A bond is issued at par value. That's quite unlikely to happen in the real world, but let's deal with it. A bond is issued for $100,000. This company said, we want to borrow $100,000 and we're going to do this with the money. And the public said, okay, that sounds good. And they borrowed the $100,000. There's no difference in this case between the cash you received and the amount that you owe. Very simple, at par value. And here's the entry to record the bond at par. Let's look at the journal entry real quick. We debit cash. We got $100,000. How much do we owe? We have a liability here. It looks like a long-term liability. It was 2 years of $100,000. Let's talk about the interest payments, okay? The issuer of the bond pays the first semi-annual interest payment of $4,000, okay? This is an 8% bond. They're telling us right here, an 8% bond with semi-annual or twice a year, every 6 months, payments. So 100,000 times 8% is 4,000 times a half a year is the 4,000. 8% of 100,000 is $8,000. We cut it in half because we're going to make 2 payments. This entry is made every 6 months. We debit the expense and we credit cash, okay? We have to pay that interest since we borrowed the $100,000. And then when the bonds mature at the end of 2021, the bonds mature and the issuer pays back the money. That's all there is to it. You pay back the cash, credit cash, debit bonds payable. Now, in the real world, bonds always trade, I'm going to say, at either what's called a discount or a premium, meaning that the company that wants to borrow 100,000 may not get 100,000. They may only get 98,000. They may get 102,000. And let's talk about these. Let's talk about a bond discount or premium, okay? Bond discount or premium. A bond has a contract rate, a stated rate. In this case, that was 8% per year. There is something, though, called the market rate. The market rate is what comparable companies are paying for their money. They're paying to borrow. So we want to always compare the contract rate to the market rate. If the contract rate is 8% and everybody else is pretty much loaning money at 8%, then the bond sells at par. If the contract rate is the same as the market rate, the bond sells at par like we just saw. But suppose our contract rate, meaning the amount we're paying on the bond, is more than the market rate. Well, guess what? If we're willing to pay 8%, like in this problem here, and the market rate is 6%, people are going to go crazy to borrow, to loan us the money because we're paying more interest than the market. So we're not going to get $100,000. We're going to get maybe $103,000. And that difference is called a premium. On the other hand, if we're paying an interest rate below the market rate, no one is going to buy our bond unless we're willing to sell it at what's called a discount. So if our interest rate is unattractive, meaning we're paying 8 when the rest of the market's paying 10, say, the bond will sell at a discount. And there's special entries to record a premium and a discount. Compute and record amortization of a bond discount using straight line. Straight line amortization is pretty easy. If you've ever heard of straight line depreciation, you know from whence I come. Discount on a bond. FILA issues bonds with the following: $100,000 par value, but they only received $96,400. Why? Why are people unwilling to buy our $100,000 bond unless we give a discount? Because the stated rate is only 8%. Stated rate means the rate that the bond is going to pay. That's the cash payment. It's lower than the market rate. All things being equal, wouldn't you rather collect 10% interest than 8%? Well, that's what these borrowers are judging in the market. So we're going to pay twice a year at the end of June and at the end of the year. The bond date is the end of 2019. It has a 2-year life, okay? Let's see what we do. Now, look at this journal entry here. This is the basic entry to record the bond at a discount, huh? How much money do we want to borrow? $100,000. How much cash did we actually receive for that bond? We only received $96,400. We're going to debit cash for $96,400. We're going to debit discount on bonds payable, which is a contra liability account. And we're going to still have to pay back $100,000 in 2 years. So even though we only received $96,400 for our bond, keep in mind we still have to pay $100,000 at the end of 2 years, okay? Discount on bonds. Now they're talking about the interest, huh? Bonds payable. This is how it's going to look in your balance sheet. You're going to see long-term liabilities, bond payable, 8%, $100,000. That number is never going to change until you pay the bond back at the end of the maturity date. $100,000 less the discount on bonds payable gives you what's called the carrying value or the net book value, the carrying value. And they're making this maybe a little bit too complicated here, but let's take a look at it. We have bond interest expense is 8% a year. And they're going to make 4 payments. So $100,000 a year times 8%. For half a year, that's $4,000. And they're going to make 4 payments. So that's where they're coming up with the $16,000. The bond interest expense, thus, in total, is going to be the discount amount plus the cash payment. We are going to amortize the discount into interest expense. We're going to write a journal entry to debit interest expense, and in this case, credit the discount 4 times until the discount is down to 0 and the net carrying value goes up to $100,000. So let's take a peek here. Entry to record interest payment and amortization. Well, how much are we paying? We're paying 8% a year, right? 8% a year, which is $8,000, cut in half because we're paying twice a year. We credit cash for $4,000. That's how much money we have to physically write. We're going to write a check for that. But we also have to amortize the discount. And the discount is $3,600. And they're using straight line method. Straight line. $3,600 divided by 4 payments is $900, making our total interest expense $4,900. Okay. Cash, that's the amount we have to pay, $4,000. We have to start getting rid of the amortization of the discount. And we do that with a debit to discount on bonds payable. The total interest expense becomes $4,900. That $4,900 has two components: the cash payment plus the amortization of the discount. And let's take a look at it. Here's a good little chart, huh? We start off with $96,400, right? That's how much cash we received. And every 6 months, we're amortizing $900 into interest expense. So we got 900 coming out of 36, that's 27. 900 minus from the 27 gets us down to 18 minus 900. Notice the unamortized discount amount is now 0 at the end of the bond, and the carrying value of the bond has now gone up to $100,000. Okay? The carrying value of the bond must be $100,000 at the maturity date. That's what the amortization is all about, turning the unamortized discount or premium into interest expense. Straight line, very easy method. Compute and record amortization on a premium. Okay, a premium. A premium is the opposite of a discount. Discount means we only got 96,400, right? A premium means we got more than 100,000. We are paying a high interest rate that has attracted some money. So we wanted to borrow 100,000. How much did we receive? We received $103,600 because we're willing to pay 12% when the market rate is 10. The bond thus sells at a premium. And again, the interest rate is 6.30, 12/31, bond date. So now our stated interest rate, which was 8 before, is now 12. Premium bonds, issue date. Well, the par value was 100,000. The proceeds, the cash we received for that bond, is 103.6. The difference is $3,600. We are going to debit cash for $103,600. We're going to credit a liability account called premium on bonds payable, and we're going to credit the bond payable for $100,000. The bond payable will always be carried at $100,000, okay? And that number does not change until the bond matures. What's going to change is the carrying value of the bond, the net book value. Like here, after the first 6 months, I guess, huh? Here's what your bond is going to look like on the balance sheet. You're going to have the 100,000. That's never going to change. That's always going to be there. Plus the premium of 3,600 means the carrying value of this bond is 103,600. We have to change that $3,600 worth of premium into interest expense. Okay? So before we get to that, let's just record the bond. We debit cash for $103,600. That's the cash we received. The bond payable is $100,000. The difference in this case is $3,600 premium liability, okay? The interest, Adidas will make the following entry every 6 months to record the cash interest payment and the amortization. And oh my, they're going through a long, clumsy calculation here, but let's simplify it. You're going to make 4 payments of $6,000. We agree? That's how much the bond pays. We then have a premium of $3,600, which is going to give us, if you will, negative interest. It's really interest income. That's what the premium is. It's delayed interest income. So we're going to, hold on one second. I'm going to stop the video and I'll be right back, okay? Hang in here with me. I have returned. Here they're talking about the interest on the bond issued at premium. They want to come up with the total interest expense over the life of the bond. And that interest expense consists of two things. The series of payments we make, the annuity payments, $6,000 times 4, $24,000, less the premium of 36. So let's look at our first entry after 6 months. We're going to make, since this is a straight line, we're going to make the same entry twice a year for the life of the bond. Start with the cash. I think that's the easy way to approach it. The cash will lead you in the right direction. How much cash are we going to pay? Well, we know it's $6,000. The bond pays $12,000. We're making semi-annual payments. So we know we're going to credit cash for $6,000. And we know the premium of this $3,600 is going to be amortized in increments of 900 4 times. That becomes our debit to the premium. We're chewing up that premium now. And the balance you need to just plug in here is $5,100. So we are paying $6,000 in interest cash-wise, but the actual bond interest expense is only $5,100 because we have the favorable premium, if you want to call it that, favorable. And here they're showing you the amortization, just like they did with the premium, with the discount. Premium. We had a premium to begin with of $3,600, right? And we're going to reduce it by 900, 900, 900, 900, so that the unamortized premium goes from $3,600 to 0 over the life of the bond, and the commensurate carrying value goes down until it reaches $100,000, at which time we pay the money back, the $100,000, okay? Even though we received the $103,600, we're only paying back the $100,000. Let's talk about retiring a bond. Retire a bond. Retire a bond. Well, we're retiring a FILA bond at maturity. That makes it easy because by definition, at maturity, the bond payable is going to be the $100,000 or the amount you borrowed. So we're going to debit bonds payable and we're going to credit cash for $100,000, okay? To record retirement of bonds at maturity. Because any discount or premium is fully amortized at maturity, the carrying value of the bond will be equal to the par value, which is the $100,000. But what if the bond is retired before maturity? Okay? If the interest rates go out of whack, it might be in a company's interest to say, hey, wait a minute, I don't want to make these semi-annual payments anymore. I want to get out of this bond deal. The interest rates have changed and I want out. If the bond is callable, meaning that the borrower can call the person loaning them the money and said, I'm out, here's your money, we're even. That party who's borrowed the money is going to have to pay back $100,000 for sure. That's how much they borrowed. And the bonds still had a premium sitting there of $3,000. Okay? So we have to adjust as follows. We have to say the bond payable is $100,000. The bonds have a call premium of $3,000, and the carrying value at the time was $104,500. $104,500 tells us that the premium unamortized is $4,500. We debit that $4,500, and we just plug the gain in. We add the debits, add the credits, and put in whether a gain or a loss. And let me just try it again. We're paying back $100,000, right? We're debiting that debt. We are stuck with that premium that's still sitting there, the $4,500. We now have to fully amortize that automatically, and we have to pay back not $100,000, but $103,000, because that's the call premium, if you will, the penalty for severing the deal. And this results, in this case, in a gain of $1,500 on the bond retirement. Let's talk about convertible bonds. I used to hear about these a lot. I don't anymore, but convertible bond. You buy a bond for $100,000 in Converse, in this example here, Converse sneakers. On January 1st, par value bonds of Converse had a carrying value of $100,000. But you called up the company, you called up Adidas, not Adidas, Converse, and you said, you know, I want to get out of the bonds market. Please take that bond money, that $100,000 I owe you, and use it to buy stock. A convertible bond is an instrument where you can change it from bond and investment to stock. So the deal is you're going to buy 15,000 shares of $2 par value common stock. Par value, the only thing you do with the par value is use it to multiply the outstanding shares. So in this case, 15,000 shares times $2 equals $30,000. You're paying off $100,000. The difference is, of course, paid in capital in excess of par to record retirement of bonds by conversion. Okay. You decided you'd rather have 15,000 shares of Converse stock, whatever it's selling for, instead of the bond. Okay. Types of notes and prepare entries to account for notes. Long-term note payable. When is the repayment of the principal and interest going to be made? The note date, we have a maturity date, okay? Maturity date is when the principal is going to be paid. The interest might be paid throughout the life of the note. So what we're going to do here is we're going to take a single payment and divide it by the principal plus the interest. I think we know how to do that, okay? And let's take a peek at this. Regular payments of principal. This note here, we borrowed $100,000, say. At the end of the note period, 2 years, 5 years, whatever it may be, we pay the whole note off, that big blue number here, huh? But in the interim, we may have to make 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. These are 13 payments. Maybe it was a 13-year bond that pays annual interest, okay? Installment notes. Foghog borrows $60,000 from a bank, signs an 8% note, 3 annual payments, okay? So they borrowed $60,000 by signing an 8% note, huh? Compute the periodic payment by dividing the face amount of the note, which is $60,000. You divide it by the present value factor. You go to the present value table for an annuity, and that conversion is 25771, 2.5771. You divide it out, you get a payment, 23,282. Okay. So let's see what we have here. We have a $60,000 note at 8%. That's $4,800. That's going to reduce the principal here. But first we have to compute the cash. And the cash is going to be $4,800 plus the $18,482 that we calculated as follows. Let me go back and make this clear. We have a $60,000 present value amount. If we divide that by the table factor, that tells us what the first payment is. So how much are we going to pay? we computed 23,282. 4,800 of that is interest expense. The difference between the cash here and the interest expense is what we're going to debit notes payable. In other words, in the first year, the note payable is going to come down by 18,482. We repeat the process the next 2 years. The cash 23,282 and the bond interest is going to go down. Bond interest is going to go down each year because we're reducing the principal. And at the end of 3 years, we have paid off this note. This was an installment note, meaning you make one payment a year at the end of the year. 3 annual payments of principal plus the interest. So we have to consider the present value here. Installment notes with equal payments, huh? Let's record the first payment. The first payment. Well, we know that every year we have to pay 23,282. And we know that the interest expense for the first year is 4,800. That leaves us with a note payable reduction of 18,482. Let's go to the next year. Again, we're going to make the same cash payment, 23,282, but the interest expense has gone down from 48 to 33, which leaves us with the notes payable of 19,961. And again, we can refer back to this table. $60,000 minus the 18,482 gives you 41,518. And that's the basis for calculating the interest expense, 8% of this number, and the remainder is the note payable, okay? You are increasing the amount you're applying to the note as the note gets older, and the interest expense goes down and down. Want to talk about a mortgage? I sure hope that every one of you someday can buy a house out here in Santa Barbara. It's not easy. You're gonna have to go to work for a while, huh? Save up a little money and convince somebody to loan you money for a house, right? A mortgage is a legal agreement that helps protect the lender if the borrower fails to make the required payments. Typically a bank, huh? You go to Bank of America and you tell them that you want to buy a house, and the house is going to cost you $500,000 and you need to borrow that amount for your mortgage. Bank of America is going to check your credit. They're going to look at your income, your bank accounts, make a character assessment. And let's say they give you the money. That means that you have to pay back that $500,000 to the bank for the next 30 years, huh? Monthly payments for 30 years, 360 payments. And in 30 years, then the house belongs to you. Until then, the house belongs to the bank. They've got the title, okay? You might hear of people, when they make their last payment on a mortgage, they have a mortgage burning party. They go out and they have a barbecue in the backyard. And they take the borrowing papers, the mortgage payments, and they burn all those documentation. Such a happy day, okay? Mortgage gives the lender, the bank, the right to be paid out of the cash proceeds from the sale of the assets, specifically identified. Well, say you make the payments for 10 years, and then you lose your job, sadly, where your income dwindles and you no longer can make these payments and you fall behind. The bank will simply repossess the house, and hopefully they'll sell it to someone else and, you know, recover some of their money. And in the meantime, they'll still continue to come after you for what you owe them up to that point. Asset debt features. Asset debt features. Bonds and notes, okay? Bonds and notes. talking about notes, right? I'm talking about really bonds. Secured and unsecured. Secured means collateral, if you know what the word collateral means. It means something of value the borrower leaves behind to the lender in case the borrower fails to pay the money back. I go into a bank and I want to borrow $10,000, and the guy looks me over and he doesn't trust me. He said, "Okay, Bob, I'll loan you the $10,000, but I need the title to your car. Your car's worth $15,000, $20,000. I need the title to your car, and then I'll loan you the $10,000." That's called a secured loan. It's secured in that if I fail to pay back the bank or the lender, well, they can sell my car. They own my car. Unsecured, someone walks into a bank and they say, "I want to borrow $2,000. The bank says, "No problem." And they hand that person a check for $2,000. That's an unsecured loan, no collateral. If that person fails to pay back, then the bank's going to have to go after them with a collection agency or start making phone calls, that type of thing, okay? Secured and unsecured. Convertible bond, we just talked about. We went over that. A convertible bond represents an instrument, a borrowing instrument that you can turn into stock in the company that issued the bond. A callable bond is any bond that can be retired before the maturity date. And there's always, I say not always, but typically a penalty involved where you're going to have to pay not $100,000, but maybe $103,000, $104,000. You're going to have to offset whatever unamortized interest exists, premium or a discount, and calculate a gain or a loss, huh? Term and serial, registered bearer, I'm not going to talk about those. Compute the debt to equity ratio. All we're going to do is take our debt and divide it by the equity. Here we go. Total liabilities. Look at Nike, huh? The current year. They have total liabilities of $10,852, and equity is 12.12407. The debt to equity is 87.87, 87%. So it went from 70%, 75, 87. Getting a little tougher. Same thing with Under Armour. Must be something in the sports apparel world where they've had to borrow more. 72, 79, 98. This ratio determines the risk of investing in a company by dividing its total assets by its total equity. So if you're an investor here, you could say for every dollar of equity, Nike has 87 cents in liabilities. I don't know about you, that seems like a lot to me. That might be typical, again, in the sneaker world or sports apparel, okay? But it is a measurement that investors look at. Well, you like to see a low number there. It'd be great to see no liabilities, huh? Bond pricing. Let's go over this a little bit, finish up with this. What the heck is this? Cash outflows related to cash payment, to interest payments. We're going to pay $4,000 after 6 months, $4,000 after 12 months, 18, etc. We're going to make $16,000 worth of payments, and the cash outflow here isn't until the end of the bond. Okay, so this is a very simple bond that that was sold at par, I suppose. Here we borrowed $100,000, no cash out until we pay it back at the end of 4 periods or 2 years. And here's the cash outflow each 6 months, okay? Not too hard. Present value of a discounted bond. Here we go. Now we're getting something interesting, huh? Par value, $100,000. That's how much we want to borrow. We're willing to pay 8%, but the market is paying 10%. So my question to you is that bond going to sell at a discount or a premium? it's going to sell at a discount because no one is going to borrow money lend money to us for 8% when they can collect 10% from the market. So with these statistics in mind, we can calculate the issue price. Calculate the issue price. And the way we do it is we're going to use the present value tables. The present value table, okay? The rate is 10% a year, right? Double check. The market rate is 10%. And let me tell you something super important. When you go to use the present value tables, you are always working with the market interest. The market interest. You are not working with stated interest. What happens if you use the stated interest? You're going to come right back to the $100,000. So we use the market rate. The market rate was, I believe, 12%, right? So here we go. $100,000 par value. We have an annuity of $4,000 per every 6 months. So the present value of $1 at 10%, the market rate was 10%. Multiply that by 100,000, 82,270. In other words, you take the $100,000, which is a single amount we have to pay at the end of the period. Go to the present value table for $1, for one number. And you'll see the conversion factor is 82,270, which equals 82,270, okay? Another way to say that is we need $82,270 today invested at 10% in order to have $100,000 at the payback time. But we also have to pay an annuity. An annuity, once again, is a series of payments of equal amounts at equal interest rates over a finite period of time. A bond is a typical annuity. We go to the annuity table and we find 3.546, multiply it out, you get 14,184. We need today $14,184 to come up with what we need to make all the interest payments. Add them together, there is the issue price of this bond, 96,454. That was with a discount. Here, let's do it the other way. Here is a premium, okay? Now the market rate is 10%, but we're paying 12. So the market rate at 10, we have the same conversion factors, but this time when you multiply it out, you get 103,546. So we're going to write a journal entry to debit cash for 103,546, credit bond payable for 100, and the difference is 3,546. And let me talk about the amortization using the effective interest method. We've only looked at straight line. Straight line is not quite GAAP, I don't believe. You're really supposed to use the effective interest method. I know where I worked for many years, the auditors would come in and they would look at the amortization tables and they would say, what are you guys using? And we would say straight line. Well, they would recalculate using the effective interest method. And if there was a significant difference, they would have an audit write-up, recommended entry to correct. We were usually close enough. It didn't make any difference here. But let's have a little fun with this before we get done. Effective interest amortization discount, huh? Let's see here. We started off with carrying value of 96,400, okay? 96,400. I don't know if you can read that. Carrying value times the effective rate or market rate, which is the same thing, equals the total interest. Can I say that again? Make this easy. 96,400. The carrying value times the market interest rate equals your total interest expense. We know that total interest expense includes $4,000 in cash. Therefore, the amortization is the difference between the cash amount and the total interest. Note that unlike the straight line method, the discount amortization is increasing. Instead of going 9 times 4 times 900, it's starting at 835, 877, 921, up to 967, okay? 100, and then you end up with the $100,000 year. So the carrying value times the market rate is your total interest. I think that's the simplest way to get it across. And once you have this number here, the rest of the numbers pop right out. There's the 4,000 for cash, and here's the amortization. Debit interest expense for 4835 right here. Credit the premium, or discount in this case, and credit cash for 4,000. We do the same thing with a premium. Exact same thing. The carrying value, 103,600 to start, times 12%, whatever it is, divided by 2, gives you 5,165. That's the total interest expense. We debit interest expense for 5,165, credit cash for 6, and the difference is the premium, 825 or 835 right here. Okay, I don't know how much of that might be on the test. In the last version of this textbook, there was quite a lot on the effective interest methods. And we'll end up talking a little bit about leases and pensions, huh? A lease. You have 2 kinds of leases. A capital lease, also known as a finance lease, or an operating lease. A lease is just renting something, supposedly. We're getting the use of an asset, and we agree to make monthly payments, say. A capital lease, a finance lease, or long-term leases, where the people who have the machine that they're leasing, they kind of get the benefit of it, and thus must put it on the balance sheet as opposed to an expense. And here are the criteria. 5 possibilities. If the deal is at the end of the leasing period, we're going to keep the machine, that means we bought it. So the lease payments are not an expense. They are capitalized. If the deal is we can buy it for a pretty good price at the end of the deal, again, it's a capital lease. So you're not going to debit lease expense, you're going to debit capital lease, an asset. Or if the lease term is for the major part of the asset's life, you buy a machine that has a life of 4 years and you're going to run it for 3, you bought it. Anyway, capital leases go on, finance leases go on the balance sheet based on one of these criteria here. Okay, criterion. An operating lease is an expense, no question about it. Operating leases are long-term, and they don't meet any of these criteria. Example is car payments, apartment rental. A good example here at the school, we have various copying machines around. We have a copying machine outside the office here. We lease it from Canon or somebody. And the deal is we lease it for 2 years. We make payments every month to rent it. And at the end of 2 years, Canon comes and they take their machine back. That's clearly an expense lease, an operating lease. We don't own the machine at the end of the deal. At the end of the deal, it goes back to Canon. Or most likely, we just sign up again for a couple more years. So 2 kinds of leases, capital leases and operating leases. What's a pension? A pension is what I received from where I used to work. It's an agreement for the employer to provide benefits to employees after their working days are over, huh? Defined benefit plan. The employer's contributions vary. It depends on certain assumptions about assets and liabilities. But these liabilities are reported when the accumulated benefit obligation is more than the plan assets, a so-called underfunded plan. You don't have to worry about that for a long time, huh? End of chapter 10. Okay, I hope this helped you out a little bit. You know where to find me for tutoring. I'm on campus right now, starting at 3 o'clock. You know where I am on Sunday evening, okay? Everybody have a good one, and we'll talk to you later. Bye-bye.